Welcome into this week's Research Corner. I'm Tony Mulvey, Senior Analyst here at FreightWaves, joined by Michael Rudolph, one of our other research analysts here. For this week, we're going to touch on these inventory levels. We saw last week big box retailers really start to cite rising inventory levels as a drag on their earnings releases, ultimately caused a sell-off in their stock prices, and highlight some of the transportation issues that they're facing as well. So really, Michael, welcome this week.
Thank you very much. It's a pleasure to be here.
Awesome. So we'll bring up this first chart that really kind of shows what the transportation aspect that we're faced with. So we've got our NTIL, so that daily line haul spot rate, and our van initial contract rate there in the green line, and you see this wide spread. We're talking about contract rates are about 40% higher than that national line haul rate. Really, this is putting, when we talk about these big box retailers, the Walmarts, the Targets of the world, they're faced with contract rates primarily, right? They deal a lot in the dedicated space, a lot more under contract, not as much spot exposure. So they're stuck paying these rates at what, $2.90 a mile?
That's right.
What do you think the impacts of this moving forward, obviously we see this, what would be downward pressure eventually, right? We talk about how the spot market kind of leads the contractor rates. Right now we're seeing the widest gap we've ever seen. Obviously it's probably going to put downward pressure, but when do you think that starts to happen?
So, given the volatility seen at the start of the pandemic, contract rates were very slow to catch up to the market. So a lot of freight moved to the spot market, spot rates increased rapidly as a result. And now we're seeing that, contract rates are, beginning to offer some sweet tea, to carriers. Those who are contracted are holding on to their loads for dear life because the volume in the spot market is just falling. So as of right now, we expected to see a bit of a decline in contract rates over the second quarter renegotiations. We're not seeing that quite yet. They're starting to stabilize. Perhaps in the next quarter, we'll see contract rates begin to fall.
Perfect. And that leads to a good quote from Brian Cornell, CEO at Target. He said, coming in, we expected to see tight market conditions and higher rates. And they're actually, in the first quarter, exceeded what they expected, right? But he was expecting that they're going to see this like a $1 billion incremental increase in those freight and transportation costs. And really what we've seen in the market is, hey, maybe there's going to be some downward pressure that may actually be a good thing for their costs that they may be underwhelming, I guess. They're over expecting totally and then see the benefits as we see contract rates decline.
This is a trend we've seen among all big box retailers and throughout the supply chain. We've seen an increased consumer demand for durable goods. Big items like furniture take up a lot of inventory space on ships and warehouses and the like. So expecting that volatility in the market, retailers over-prepared and are faced with blooming inventory costs. There's a lot of space being taken up.
Yeah, and that actually brings up this next chart that we'll pull up. And it's a chart that I put together kind of looking at these inventory levels of these retailers and as grocers as well. What you see, Albertsons and Kroger, so two relatively big grocers in the public markets are seeing inventory levels actually negative year over year. But look down at the bottom, you'll see Target and Walmart. Walmart being the largest grocer in the country, you see inventories up 43% at Target and 32% at Walmart. And Doug McMillon said it on their earnings call. He said, we like the fact that our inventory's up. So much is needed to be in stock, but a 32% increase in inventory is higher than we want. So it really shows that Walmart and Target are all facing these slowing consumer conditions, right? And they've built up these inventory levels to levels that don't really need to be there. What's it mean coming down the pipeline? Probably some discounts, things like that, just trying to get it off their books.
Right, and as a research analyst, I worry kind of for the future market conditions, but as a red-blooded American consumer, I'm wondering when are these flash sales going to come? Probably pretty soon.
Yeah, and I think the one concerning part, and we've talked about this a bunch, we'll pull up the chart here, is this revolving credit. It's basically outstanding credit card debt. What you saw, this big U shape. We saw the pandemic really strengthen those balance sheets. Right now, we're almost back to pre-pandemic levels, which is kind of a cause for concern when you think about the rate of inflation starting to have to buy things on credit instead of being able to use cash. Ultimately, The cost of debt's going to get elevated as those interest rates increase. What's that mean? It's going to be tough sledding probably for the consumer here in the coming quarters.
Right, and one last worrisome trend for retailers is that consumers are demanding more services. They're spending more on gasoline, transportation, lodging, things like that. So a lot of inventory is going to go.
Yeah, perfect. Well, thank you, Michael, so much for joining us this week in this research quarter. Right now, we'll take a look at a FreightWaves Classic talking about the Port of Miami.